Hope you're having a good morning. My name is Fred Barnashawi, Managing Director of Dashit Capital. It's a risk consulting company that advises businesses, including financial institutions, on how to manage op risk, transfer it through insurance, and then monetize the insurance. We currently operate in Canada and in the Middle East, and today I'll talk to you about transferring the op risk through insurance. Just a bit of background, Dashit means the red crown that pharaohs used to wear, and that symbolizes Lower Egypt, which is the northern part of Egypt, which is where I'm born. And the slogan, converting risk into growth, is pretty much what we do. But before I start the presentation, I'd like to take a minute, thank PRMIA and the organizing committee for this wonderful conference. Thank you all for attending. Good to be here. And also welcome everyone who flew in from abroad to attend the conference. Let them know that Canada is a great country. I spend 4 months of the year here in Canada during the summers. But it is truly a great country, not only because it promotes equal rights and opportunities, but if we tie it back to risk management, it's at the forefront of the practice of risk management globally, and that was evidenced by its resilience in 2008, 2009. So I think we should all be proud of being part of this and having contributed to this ecosystem. Now, a short summary about what we call the op risk swap. It's really insurance that matches the operational risk of financial institutions, and we structure it through existing insurance that the FI purchases or through new insurance. And we use our proprietary finance-based methodology for that. And what that does is for the FI to yield monetary benefits, operational benefits, and much stronger protection against long-tail events and more statistically frequent operational loss scenarios. Now, the first slide, I just want to talk about Brexit for a second. It's a recent event. It wiped out $2 trillion off the market in one day, the single biggest drop ever. Has a lot of implications, and I just want to ask some rhetorical questions. Is it a form of market risk, a form of investment risk? Is it a form of political risk, operational risk, etc.? And the reason why I'm asking these questions is because there is a proven correlation and overlap between the different types of risks. And this is not something that's new, but I'd like to highlight it because it's very important for the sake of this presentation. Table of contents about the company, which I just talked about. This slide is talks about why we do what we do. There's an inherent flaw in the traditional insurance industry, which is the traditional insurance products are statistically made for the insurance company to win. I'm talking about business insurance here. So a lot of smart actuaries work at insurers and make sure that happens. The broker of insurance doesn't have the business model to change that, simply because they have profit margin requirements to meet and they don't have the resources to fight back against the insurer. So what ends up happening is that the end user of the product gets stuck with a statistically irrelevant product and the illusion of security. In fact, there are billions of dollars tied in North American courts as a result of insurance breaches of contracts. And you can imagine how many other billions of dollars exist with respect to insurance disputes that are not tracked by the court systems. So this is a real problem. And at the core of the problem lies the concept of basis risk. Just like financial derivatives, traditional insurance products have basis risk. We measure that for our clients before the structuring of the op risk swap and after. And really, when you match your operational risk to insurance, you lower that basis risk to a minimum. So I talked about how we do it. We structure new insurance from scratch on behalf of a particular FI, or we take their existing insurance products and we transform them into op risk swaps, essentially. This is just a sample list of products. So liability products such as directors, officers, liability, errors and omissions, mergers, acquisitions, etc. First-party products such as financial institution bonds, fidelity products, etc. And credit and performance products, trade credit, surety bonds. So there's a whole list of products, including cyber as well, that we can transform into these op risk swaps. What this means to a financial institution? Well, we know there's a definition for operational risk. For the sake of this presentation, we're using Basel II. I understand that some large global banks have their own definitions of operational risk as well. But we also know operational risk can be masked as credit risk, investment risk, market risk, and whatnot. So when we match operational risk through insurance, we automatically pick up portions of the other different forms of risk that are very relevant to a financial institution. And there are four main benefits as a result. Monetary gains, meaning the insurance policy pays out a lot more often because now you have a statistically relevant insurance policy that picks up a lot more risks, so pays out a lot more often, not just once every 40, 50 years. Part of the monetary gains is having the potential for capital relief if you're able to lobby your regulator correctly. I'll talk about that in a second on op risk regulatory capital. The second benefit is operational gains. Just by structuring these op risk swaps, you automatically lower your own risk profile. And by integrating a lower risk premium into your operating models, you can be more competitive in the marketplace, and I'll talk about that in a second as well. Third, much better protection against tail events and more frequent operational loss scenarios. And fourth, strong sustainable risk management framework. Quickly on this slide, these are just two diagrams that I like a lot by KPMG. They're very simple. The first one on the left shows the overlap between operational risk, different types of risks, liquidity, market, credit, etc. And the second graph on the right shows you how the operational risk function is really tied to several different functions within your organization. Examples of operational benefits. One, I'll talk about lending first. When you integrate a lower risk premium into your models, you can lend at more competitive rates because now you're picking up portions of operational risk and portions of credit risk, and hence increase your universe of borrowers. Asset management. By picking up operational risk, you pick up portions of investment risk and market risk, and so you are able to offer more security to investors during downward trends or a downward performance. And that has an effect on redemptions, attracting new money, etc., fund returns. Investment banking, M&A, corporate, as well as private equity as well. You can transform the mergers and acquisitions traditional insurance product currently offered in the marketplace into a much more relevant operational risk swap to pick up the unique deal risks. And that has a direct effect on liquidity, aside from the ability of the seller to release escrow capital. If you're able to insure the risks of the deal that are relevant to the buyer, it affects liquidity and marketability of the deal. And if you're able to integrate total cost of risk into your valuation models, you can influence discount rates and projections on cash flow as well. Potential for capital relief. Right now, we're, as Ross had mentioned, we're using the AMA according to Basel II, Basel III. That might be switching very soon to the standardized approach. But I don't think that the regulators are going to change their stance on the ability to substitute your op-risk-based capital through adequate insurance. This is very important, but it's also very dangerous. It's been done in Europe. However, I don't think it's been done correctly because they don't really look at the insurance policy in a very accurate fashion. You're essentially substituting liquidity with illiquidity, which could eventually harm the financial institution. However, this is one of the monetary benefits you can achieve if you lobby your regulator correctly. Process is simple. Well, this is the macro process. Gather data, categorize risks, figure out what coverage is relevant to your own op-risk profile, and structure the product. Give it to your own broker of insurance who distributes it to a bunch of insurance companies that say yes or no or participate in rounds of negotiations. And that's one end result. The job is not done yet. You need to figure out how to trigger that insurance policy effectively in order for effective payout and in a timely fashion. This distribution curve summarizes the entire presentation. Basically says that the op-risk swap is able to pick up tail events and more statistically frequent operational losses at a much lower basis risk than traditional insurance, which only picks up tail events at a high basis risk. A direct effect on your ROI on insurance, which has a direct effect on shareholder value. and that's statistically proven. Here I break down the ROI that so into the return components is broken down into policy payouts, operational gains, potential for capital relief, and the cost is broken down into cost effectiveness, which is essentially the premium you pay for the insurance. The chances of that dropping is pretty high because when you structure the operational risk swap, you also get rid of a lot of unnecessary coverage that was in traditional insurance. So your premium is likely to drop. And then the opportunity costs. For those who spend millions of dollars on traditional insurance products, you could have used those millions of dollars somewhere else. So who should be in charge of that purchase at your financial institution? I've seen a lot of financial institutions get it wrong. Some of them get it right, but it certainly has to be someone who's in touch with your day-to-day operations and your risks. And we would coordinate with them. They would coordinate with the head of business units, as well as there could be an insurance risk manager depending on your size. And we would do the data collection process at that level, and then structure the product and then give it out to the broker and the insurance company. And this is the final slide. Briefly want to touch on regulation. I'm not talking about Basel II, Basel III here. I'm talking about local insurance regulations. Regulation is supposed to protect the business and the consumer, but based on data we've collected, the current insurance regulation is really benefits the insurance company. So we estimate that insurance companies on business insurance can make up to 80% profit margins on products that are regulatory driven. So I do urge regulators, and Canadian regulators are far better than a lot of other regulators, but I still do urge regulators to incorporate independent operational risk and finance folks when drafting these regulations, because at the end of the day, they can create mini OPRIS swaps that can provide protection, much better protection to the business and the consumer at the same cost of compliance. And this is it. Thank you for attending the presentation, and happy to take any questions. Thank you.
You opened your presentation with the comment around Brexit. Could you give an example of the type of insurance that you provided and what was the process and how did that work and how the payoff was actually given out?
Brexit specifically was not part of it. Brexit was just an example, an illustration I used in this presentation, just to highlight the overlap between the different types of risks. We're working, and we've worked in the past on a lot of products that are base products offered by insurance companies, namely directors, officers liability, and errors and omissions liability. And these products are drafted in a certain way. And we take these products and we switch them around, given your measure of op risk or given our measure of your op risk. In some instances, the results were that our clients were able to shift their business decisions, such as lending decisions, based on the risk premium that they dropped or they were able to reduce. In some instances also, they were able to make smarter decisions on where to lend, based on the ability to figure out that there are some losses that they previously thought that they were covered for are not covered. So cat losses, for example.
So my question is with respect to your last slide, which I noted you mentioned that insurance regulation serves only insurers and brokers. So I'm wondering, what exactly are those aspects that led you to your conclusion? So what aspects of regulation would you say in particular would only serve insurers and brokers? And secondly, would you think that regulators would agree with that assessment?
Based on, so we've got experience at the insurance company level and at the brokerage level, so we accumulated data on regulations such as the OSC's NI 31103, for instance. which is a very basic regulation requiring portfolio managers to hold financial institution bonds. Within the regulation, there's certain coverage required that really doesn't, to put it bluntly, it doesn't really relate in any shape or form to the portfolio manager, such as covering their custody of assets at the portfolio management company level, which doesn't happen. The custodian is usually a bank or a Schedule A bank. So this is just an example of irrelevant sort of coverage that is required upon the business and that they ultimately buy, and there's a premium attached to it, but there's no actual relevant loss scenario. So the insurance company really is making up to an 80% profit margin on that. 80% because they got 20% cost, staff, IT, all those like operating expenses. But when you take a look at the actual loss scenario, it's irrelevant. Another example is has to do with the errors and omissions requirements on broker-dealers across provinces. So while regulators push those requirements upon broker-dealers, they don't really get into the details as to what the policy should be covering. I mean, I can get you an errors and omissions policy right now and give you proof that I bought it, but that doesn't mean anything about whether it picked up my core risks or not. So there's a gap. The dots are not aligned or aligned correctly. They don't do that.